Hey traders, Money Badger here again, and I'd like to welcome you back to Badger Trading University. If you haven't already joined the BTU Discord, click the link in the video description below. In our previous video, we gained an understanding of the MACD indicator, which stands for Moving Average Convergence Divergence. In this video, we will take a look at the RSI indicator, which stands for Relative Strength Index. Traders will often use the RSI in combination with the MACD to identify better trading opportunities. As a leading indicator, the Relative Strength Index, or RSI, measures the magnitude of recent price changes and can be used to identify possible trading signals and anticipate trend reversals. The RSI oscillates between two extremes and can have a reading of 0 to 100. When an asset decreases rapidly over a short period of time, the RSI typically reaches a value of 30 or below and is considered to be oversold. And when an asset increases rapidly over a short period of time, the RSI typically reaches a value of 70 or above and is considered to be overbought. Let's take a closer look at how traders may use the indicator to identify potential trading signals. When the RSI crosses below 30 into oversold territory and then crosses back above 30, a potential buy signal is produced. And similarly, when the RSI crosses above 70 into overbought territory and then crosses back below 70, a potential sell signal is produced. Now that you understand how traders can use the RSI to produce these simple trading signals, let's dig a little deeper and discover how traders can use the RSI to identify potential trend reversals. The first strategy is to identify divergences between an asset's price action and the RSI, which indicate weakening momentum and anticipates a trend reversal. A bullish divergence occurs as an asset's price creates lower lows while the RSI creates higher lows. And a bearish divergence occurs as an asset's price creates higher highs while the RSI creates lower highs. The second strategy that traders can use to anticipate potential trend reversals is to identify bullish and bearish swing rejections. A bullish swing rejection can be seen in the chart shown here. Notice that the RSI moves below 30 into oversold territory. Then, the RSI bounces back above 30. Next, the RSI drops again, but it holds above 30. And finally, the RSI breaks above its most recent high, which produces the potential buy signal. A bearish swing rejection can be seen in the chart shown here. Notice that the RSI moves above 70 into overbought territory. Then the RSI pulls back below 70. Next, the RSI bounces back, but it holds below 70. And finally, the RSI breaks below its most recent low, which produces the potential sell signal. And as always, I would like to remind you that it is important to understand that most indicators, the RSI included, are not meant to be used as standalone indicators when making trading decisions. Trading with confluence and stacking elevating factors can strengthen your risk management and prevent entering or exiting a bad trade based on false signals. Always look for multiple signals to support each of your trading decisions. Thank you so much for watching. If you enjoyed the video and learned something new, please like, subscribe, and join our Discord by clicking the link in the video description below.